Yeah, it was a half decent move to the downside, percentage-wise. Let's just see what that was. 5% move. But keep in mind, gold miners move 5, and sometimes even this ETF, it can move like 5, 8, like 10% a day. So you have to make sure you're giving it enough wiggle room. So when one of those extreme days hits, that actually shake things up and cleanse the market, that you don't get shaken out.
Honestly, I thought we'd pull back off of this level. Instead, closed above, confirmed, and even the retrace held, which is what it's supposed to do once it confirms, and now it's pushing up. Now, if it ever breaks here, that's a very big negative sign, but it hasn't done that yet. Silver. You guys know what's been my upside target on silver? 48 to 50 bucks. I wouldn't be surprised if early next week it tags 50 bucks. Then I start to think it probably is due for a pullback off a double top. That would be a technical double top.
In the current precious metals landscape, volatility is no longer a sign of weakness. It's a feature of strength. Gold and silver are displaying robust structural resilience amid short-term pullbacks, with markets digesting high-volume swings and profit-taking phases that often precede larger breakouts. Traders are learning that the difference between noise and signal lies in patience and proper risk management. Pullbacks, in this environment, aren't warnings. They're opportunities to reassess positioning before the next move higher. Both metals continue to build momentum, holding key technical levels despite broader market fluctuations. ChrisVermeulen, Chief Market Strategist at the Technical Traders, and Gareth Soloway, Chief Market Strategist of VerifiedInvesting.com, highlight how traders must adapt to this dynamic cycle environment. Gold's steady march toward $4,100 and silver's potential move toward the $48 to $50 zone represent more than just price targets. They're markers of changing sentiment in a world searching for stability. Their analysis underscores the importance of recognizing time cycles, Fibonacci extensions, and psychological pivot points as the market transitions from consolidation to acceleration. The key lesson is clear. Flexibility and discipline matter more than prediction. As liquidity rotates and fear drives money toward tangible assets, understanding these structural shifts becomes critical. Gold and silver remain the most direct beneficiaries of capital flight from overvalued markets. Stay informed, stay disciplined, and never underestimate the power of technical structure. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold is continuing to muscle its way higher. When we take a look over at gold, let's just zoom in here. Gold has had a 2-day, or you could say now a 3-day pause. It's getting ready, from the looks of it, to have another pop and move up towards 4,100. If we look over at silver, nice gain today, 3.4% upside. It poked to some multi-year highs. Today, again, it has some volatility, which is what we've talked about. We are seeing some bouts of selling. Expect things to have big pops and big drops and to try and shake things up. We're getting into high volume periods. You can really see it in the stock ETFs. The silver miners, we've got big volume in there, probably on gold miners, the large caps. Actually, it's not too much larger than normal, to be honest. Gold can decouple from this, but you can see here we did see gold pull back. We had gold's holding up here with some fear in the markets, so it might want to decouple. But again, just knowing what the broad market, the masses are doing. Are they all hitting the buy button? Are they all hitting the sell button? Those give us these critical turning points of overbought, oversold conditions. The reality of managing risk is you do need to give it wiggle room, and you're never going to get out of the top. You're going to have to give back a chunk of the gains unless you pick a top. And the problem with picking a top is you get out early, and then the market just keeps going up without you, and you're left behind. And that is the scenario for, I know, a bunch of positions, a bunch of you as well. So, and that's just part of trading. There's nothing wrong with being left behind, especially if you hit a target and you've locked in gains. It's not about making as much as you possibly could and you left money on the table. It's about you made the trade, you followed your rules. If you get stopped out, that's actually a good thing because it means you're following rules and you are protecting your account. So sometimes getting a little left behind or not getting the last portion of a move, it feels bad, but it actually means you're a disciplined trader. So I'd pat yourself on the back if you did get shaken out It's just understanding how much room do you have to give based on your trades. If it's a very fast momentum trade, then maybe you did put in a tight stop. I mean, I usually use some standout lows. Just visually, I go back on the charts and I'll just use some standout lows as a level. Like obviously this is a pretty key level. This is a pretty key level. You could argue this is, looks like a pretty key level. I'm not sure if it broke that low or not. It looks like it did, which is maybe why some of you got a stop out. But these kind of multi-day lows, like a rounding formation, these are usually more critical stops, right? The market can have these bull flags and spikes along the way. If you use a longer time frame, and you just look at cycles, you can always throw cycles on these charts. You'd be like, oh, here's a cycle. And you can figure out where these cycle lows are, which are really hard to see, the color coding that just went on this. But if I was to change all these colors to, say, white, and we just look at these, you can say, okay, well, here's a middle of a cycle low. Here's a middle of a cycle low. This big spike, we could say, hey, that's, that could be the next support level here. That was based on just time cycles, right? The market moves in some interesting time cycles. So it looks like it just had a low. Maybe it's going to want to push higher. And then in, I don't know how many days this is, in 2 weeks from now, it has like another cycle low. But it might be at a much higher price, right? Price could just keep moving up and have a cycle low up here. So yeah, and another one of you was saying, well, maybe you guys should just use Fibonacci targets for your own individual stocks. And I think that's great. You pick a stock, you do your measured move, and then you'll know where that upside target is. And you can also, if you stair step it up like I did with the S&P 500, where a new rally started, a peak and a pullback, you can use those significant pullbacks as your support levels. Just like I showed you on this cycle chart, you kind of want to pick a significant low where it's either a very sharp drop and it's some type of big washout low, or it's a multi-day kind of reversal where price sold off and it eventually found support and then starts the next wave up. The markets always have a way of fandangling things. They could be nice rounding formations, or they could be a super sharp spike. Either way, they're just different types of bottoms. And we saw that in the stock market. If we go back over here, sometimes we have these super spike standout lows. And of course, these can shake traders out. We had another huge spike in reversal here. And other times, if we go back and look over here, it's more of a rounding bottom, right? So you just have to have a strategy that can kind of protect you from both. And that means more wiggle room and usually zoom out on the charts to get a feel of those time cycles of when cycles you should be looking for some significant low to go off of.
Gold and silver are both holding critical technical structures that define their next significant directional move. Gold's breakout above the upper channel confirms a new phase of upside momentum, with that same level now acting as substantial support. As long as price action holds above it, the probability remains skewed toward higher highs. Meanwhile, silver continues to show remarkable strength, reaching $48.37 and closing in on the psychologically important $50 mark, levels that could trigger short-term volatility but ultimately reinforce its broader bullish setup. Across the broader markets, the S&P 500 and Nasdaq are flashing early signs of exhaustion, pressing against long-term resistance lines that date back several years. These wedge structures, combined with potential topping tails forming on daily charts, suggest that a technical correction may not be far off. If confirmed, such a shift could accelerate capital rotation into hard assets, particularly as semiconductor and tech giants exhibit signs of fatigue. The volatility index also hints at rising tension beneath the surface, foreshadowing increased market turbulence. Momentum, probability, and discipline are what define success in these cycles. The charts don't lie. They reveal where the weight of money is flowing next. Let's get back to the interview.
Gold confirmed above the parallel channel. So what do we know? The parallel channel now, this upper line becomes major support. Yesterday it fell, bounced, today up again today. Now it didn't make a new all-time high today, so let's keep that in mind. But until it, if it breaks below and confirms back below, okay, then it favors the downside. As long as it stays above this yellow line and doesn't confirm below, guess what? It's got upside bias. And that's just probability. It has nothing to do with how I'm positioned. It's just like, that's what the charts tell me. Like, listen, sometimes I'm like, hey guys, this chart just turned bullish today, and I might be short something that's relative to that. That's my problem. I'm going to tell you guys exactly what the charts are saying, right? It's a probability game, and from day to day, things can switch, and they do switch oftentimes. All right, my goal is just to listen. I'm going to be wrong 20, 30% of the time. I want to be wrong 70. I want to be right 70 to 80% of the time. But again, the charts, when they change, I'm going to tell you straight up, no sugarcoating. It is what it is. All right. So again, I honestly, I thought we'd pull back off of this level. Instead, closed above, confirmed, and even the retrace held, which is what it's supposed to do once it confirms. And now it's pushing up. Now, if it ever breaks here, that's a very big negative sign, but it hasn't done that yet. Silver. You guys know what's been my upside target on silver? 48 to 50 bucks. Guess what? We made a new high on silver today, going to 48.37. I wouldn't be surprised if early next week it tags 50 bucks. Then I start to think it probably is due for a pullback off a double top. That would be a technical double top. Oil today, we know we filled the gap yesterday. Did it get a bounce? I mean, I don't know. It was earlier, but it basically is flat. That's not a very strong performance at gap fill here. That's not a good sign for oil. Now, listen, it still could bounce Monday or Tuesday, but overall, I still think, I mean, the chart on oil is not a great chart right now. It is not a great chart. Natural gas, let's take a look at nat gas real quick. Nat gas, you can see these trend lines. High pivot down here, low pivots right through here. X marked the spot, reversed. I did give that 360 level here. It even went a little higher to this next level. But look, you saw the pullback today. Now, again, I'm still not in a trade on oil. I have no trade on nat gas right now. I'm just being patient, but certainly something I want to just continue to pay attention to overall. But wow, this market, folks, I'll tell you, kind of boring early in the week. You think, well, the government shut down. We're not going to get the jobs data. It's going to be blah, blah, blah. All of a sudden today, things got spicy. My eyes opened wide and my ears perked up with the market in the trading afternoon today. It was so interesting because usually, I mean, all week, like afternoons have been dead, floating. And then all of a sudden today, get ready. And listen, maybe there's nothing there. Like I said, probability, there's always a certain probability. Markets ignore it. We go back to floating up next week. We'll find out. But there's certainly some signals here. All right, there's certainly some technicals that I'm paying attention to. So let's take a look at the S&P 500 here. So the S&P 500, guys, this is really important because look at what is going on right now. You hit the high end. So this is, if you've been following my trading game plans in the morning, you know exactly about this wedge pattern, right? I mean, this wedge pattern goes all the way back to October of 2023, connects through the big correction in 2024 to this low in early 2025, right? Now, this is where things get spicy. We ultimately kissed the level here and pulled back, and then look at the high today, right to that line. As soon as we hit that line, we saw major selling come in the markets to the point where we are borderline putting in a topping tail. So not only did we hit the high end, but we could be putting in a bearish reversal candle on the S&P 500. We'll see where it closes in just about 3 minutes time. But this is big, folks. Now, it's not just this. In addition, the QQQ, look at this, guys. The weekly chart on the Qs was trying to break this low from COVID. This is the COVID low on the NASDAQ 100, connecting right through here. Every time it went to this point, it corrected 15%, hit here, fell 26%. Where are we? We're right up there, and the QQQ is negative again today, trying to pull back off this level. So what do we have? We have the NASDAQ and the S&P both at critical levels on the markets. The S&P possibly putting in a topping tail. We now have 2.5 minutes remaining in the trading day. I'm following it into the close because a topping tail from a technician's point of view, from technical analysis, that is significant. Listen, the trend line hit is great on the S&P. That's what we knew was going to be resistance. But if you couple that with a topping tail, it becomes more significant. Now, that's not all. Speaking of which, let's go back to the S&P. Is this a topping tail? It certainly looks close. I would have to do a measurement. Oh my goodness, we closed flat on the S&P. S&P up 41 cents. I have to do a measurement. It's so close on whether it fits the criteria for a topping tail or not. I will keep you guys in the loop and find out. I don't want to tell you the wrong thing, so I'm not going to, I literally have to do calculations on this. But man, oh man, that is impressive. If it's a topping tail with a hit of this line, I would say by early to mid next week, we could be all the way down here. And then that would be the seventh hit, which is a time count of this wedge pattern. Let's watch, guys. Let's see what happens here. All right. All right. So going back to stocks that are breaking down, we have Netflix. We have Meta. I mean, if you look at other names, I mean, we talk about Broadcom. Broadcom, from the highs on earnings, has come in. Oracle, look at Oracle, just keeps going down. I mean, had this little bounce a few days ago, but this thing's coming down. This was the biggest move up on earnings that we have ever seen on a stock of this magnitude. I've never seen it in my career. No one ever has, because it was a first ever, but this is something that is important here. Again, and look at how it's just fading to the downside. Now, what's the crux? What's holding up the market? The answer is the semis. Where the semis go, the markets follow. That's an adage that I was told 25, 26 years ago when I started trading, and it's true to this very day. So let's look. We looked at NVIDIA. We already know NVIDIA is into resistance. What is the SMH doing here? Look at this. So SMH was down. No big deal. SMH was down $1.51 today. Not even 0.5%. Literally nothing to write home about based on percentages. But to me, is this a significant trend line? Bull market high of 2021 to the bull market highs in 2024. Then we had the big correction. Look at what we just tagged. I don't know. Again, breadcrumbs, smoke, there's fire. You could use a million analogies. To me, if there's going to be a top in the market with complacency and the VIX. Now, I will show you one thing that I was not happy about today. Okay? The VXX, I love it. It's a great downsloping wedge. It literally was trying to break out today. I want to show you this, guys. Now, listen, it's not the VIX, but it's close enough. It's for us that trade ETFs. This is about as close as we get. Look at this. Here's your wedge. These wedges are very powerful when they break out. Like literally the VXX should go above 40 when it breaks out. Was this a breakout today? I don't know. I mean, it's right there. I mean, you could say, oh, it looks like it closed a fraction above. It might, or is my line fractionally off, right? So as a technician, as someone who's drawing trend lines on a chart, I hate when things are so close because, well, what if I made a slight, what if I just drew it here, right? So when it's an obvious close above or below, it's like, well, duh. I mean, even if my trend line's off slightly, it's still an obvious breakout.
The setup we're seeing now in precious metals isn't just another short-term move, it's a shift in narrative. Momentum, structure, and macro alignment are converging simultaneously, creating an environment that rewards those already well-positioned. Gold's strength continues to validate the trend, while silver's compression beneath historic resistance levels is a sign of underlying accumulation, not exhaustion. When the next expansion phase begins, it will likely surprise even seasoned traders with its speed and scale. This phase demands clarity, patience, and conviction. The technical picture indicates that market transitions are already underway, even if the mainstream narrative has not yet caught up. That's why it's essential to closely track these setups and stay informed, rather than being reactive. If you found this analysis helpful, make sure to like this video, subscribe to the channel, and share your thoughts in the comments. Your engagement helps keep this conversation moving forward.